Okay, estimated tax payments. Trent, how often do we have to think about estimated tax payments?
Do you?
Do you?
A lot.
A lot. I hate estimated tax payments. Is there anything I like? Okay. Max, what's number one say up here? Because I don't remember what the hell I wrote. I'm sure this is going to be meaningful and riveting.
Why do estimated payments need to be addressed by the taxpayers? The IRS wants to be paid as soon as possible to fund government operations.
Okay, what's two say?
If the government wants or needs cash to operate, what are the funding sources from income tax? You got withholding on the W-2, estimated tax payments, and then tax paid through the income tax return when it's filed.
Okay, what's three say? Because I'm going to make a point here sooner or later, and both of us are going to be surprised.
Sweet. Look forward to it. Does the government have a required minimum amount a taxpayer is required to have on deposit via withholding and estimated tax payments? And the answer to that is yes.
Can you articulate what that is?
Um,
I'm sure I have it in here somewhere. How do we know what the minimum is? Yeah, Connor?
Isn't it based on like your prior year tax liability?
Could. That's part of it. It's two-prong, or not two-prong, two possibilities.
well, you got prior year and then current year.
Prior year and current year. Okay, so and I'm sure this is here somewhere, but we might as well see if we can guess. If we're saying prior year, what else will we be saying about prior year as a measurement tool?
You gotta look at what your AGI was last year.
Your AGI. How do you feel about that, Matt?
I like that.
You like that? Sam?
I don't know.
Luke?
Not too sure either.
CV?
I don't know.
Allie?
Maybe.
What, was that your phone?
Yeah.
Because I'm like, did she just throw her voice? What the? I was actually partially freaked out by that. What'd you say? I thought this was you. What'd you say?
Maybe, like it sounds right, but I don't know.
Okay,
I think it sounds right.
sounds right. Jackson?
Sounds right, but probably have to confirm.
Have to confirm. Who did we start with? Did you say that?
I didn't say anything.
I said it.
How do you feel about that?
Well, it's either AGI or tax liability. One of those two.
How do you feel about that?
I don't know if this is related, but isn't there some, like, what if you're above a certain amount, you can't do like the prior year? If that makes sense. No, okay, I'm off.
No, but there is something embedded in the prior year that if you're over a certain amount, a rule changes.
Okay, that's what I was.
But
That's
but-
off.
But our clients, I would say, we never default to, we always only view that as one-dimensional, because the first part of that rule, our clients wouldn't be our clients if they were in the first part of the rule. Fair?
Mm-hmm.
Okay. All right, so let's see where this goes. Jackson, what's number 4 say?
It says, does the government have one methodology or multiple approaches? And they have multiple.
Okay. Oh, look at this. Holy shit, we were ahead. What do you got?
What are the methodologies? A, estimated tax payments based on current year earnings and tax. And then B says estimate tax payment based on prior year tax.
So, Chris, is that AGI or tax?
I mean, that's tax.
Okay, so you were close. I mean, you referenced AGI, but it's really based on the tax that was due.
I was thinking about something different, I guess.
Okay? All right. Okay, Chris, what's 6 say?
Estimated tax is based on prior year tax. In general, you can make estimates based on 110% of prior tax.
What are our facts?
Year one income was 200,000, which resulted in 60,000 of tax due. The taxpayer had a withholding of 50,000, which resulted in a tax due with the return of 10,000. A, what is the required amount that needs to be on the deposit with the IRS? 110% of prior year tax.
Okay? Okay, so what that just said, I mean, when you look at a 1040, you know, not that anybody in this room would do it, this concept of tax sometimes gets lost in the noise because you have three numbers that are embedded in that example. You have the $60,000 that was due, you had $50,000 worth of holding, and then you had $10,000 that was due with a return. And the most likely mistake that people make is to say, well, there was $10,000 due with a return, that's the number that we're going to key in on, which accidentally could be correct, but it's not correct. Could accidentally be, but that's not the right way to view it. So you have to look at, I had $200,000 of taxable income. I took that $200,000 times a 30% tax rate. That $200,000 times the tax rate resulted in $60,000 of tax. Then I have to measure that against what I have on deposit through withholding, which is $50,000, which means I have $10,000 due with a return. The amount that I key in on is a prior tax, which is the taxable income times percentage and times the tax rate gets me to $60,000 due. Prior tax is $60,000. 110% of that prior year tax is $66,000. So in order to be on safe basis, and what does safe basis even mean? Why are we even doing this? What does safe basis mean?
So you avoid underpayment of tax penalties.
Yeah. They want you to have an amount on deposit with the IRS to say that you aren't treating the IRS as if they're the bank. Okay, so I'm not going to talk ahead. I'm just going to take the tour with you guys because I'm sure I did a great job of putting this together. CV, what's B say?
If we assume that the taxpayer has year 2 earnings of 1 million because he or she won the lottery and he or she is projected to have 26,000 of withholding, what is the required amount of estimated tax payments? 66,000. How much is projected to be on deposit? 26,000. What is the required estimate tax payments? 40,000. How are they required to be paid? 10,000 per quarter. 5. Could the taxpayer pay it all in the fourth quarter, not without interest and penalties? 6. What will be due with the tax return? Assume 30%. 234,000, which you get from doing 1 million, or I guess you'd take 1 million times 80%,
That's 30%.
30%,
I'm assuming a
and
30%
take out,
tax rate.
and take out 66,000.
Boy, there's a hell of a lot of information in there. We just went through a lot of moving parts in that. So let me ask a stupid question. And before, there were two options, weren't there, in terms of how to interact with your estimated tax payments? What were the two options? What were the two options to arrive at the calculation? Was it current year and prior year? And prior year was 110%. And current year is going to be 90% of current year, but we'll get to that. Okay? So, is this taxpayer won the lottery and they won $1 million. So let's pretend for a second that you have to have 100% of the current year on deposit just for ease of math. And we know we have a 30% tax rate. 1 million times 30% is how much, Jackson?
It'd be 30,000.
30.
Wait, what did you say? Sorry.
1 million times 30%.
Oh, it'd be
300,000.
yeah.
Okay. So if we were going to use that as a methodology, we're going to use the two methodologies to say what do we have on deposit. Well, under the current year methodology, assuming we're using 100%, not 90%, methodology 1 would say we would need to have on deposit for methodology 1 $300,000, correct? So methodology 2 says we have to look back at prior year. What were the facts from my prior year? Chris?
Last year they paid 60,000 in tax, so 110% of that, 66,000.
Okay. They paid $60,000 in, right? And that's what you said, times 110%, because it's going to be 110% prior year. So 66,000 on deposit. So now you've quantified two numbers, and I'm sure that I'm talking ahead at this point. Okay, so now would you rather pay $300,000 in estimated tax payments to be square, or would you rather pay $66,000 and keep some cash in your pocket and earn interest until you have to pay it? Which would you prefer?
66.
66. So this is the process of measuring what amount, how am I going to approach this with prior year or current year, and which is better for me? And oh, by the way, one is way easier than the other. So in this case, this taxpayer say, forget it, I don't want to put, $300,000 on deposit. So I know I'm going to look back at last year. And how did you quantify that, Chris? What was the number?
Of last year?
Yep.
It was 60,000.
110% is what?
66,000.
66. So then there's additional facts that are provided, correct?
Mm-hmm.
How much is projected to be? Oh, it says if we assume that the taxpayer has year two earnings of 100 or a million, he or she won the lottery, and he or she is projected to have $26,000 of withholding on deposit. Does withholding on deposit count towards the $66,000 calculation? It does, because what they care about, they don't care about whether you fund it through withholding. They don't care whether you fund it through estimated tax payments. What they care about is having $66,000 on deposit. That's what they care about. So in order to get to the right number for estimated tax purposes, you have to first quantify what's the global amount that has to be on deposit. 66,000. And I know it's 66,000 because I took prior year tax times 110% to get to that number. Then I say, well, wait a minute. How much should I have on deposit due to withholding? I have 26,000. All right, since that's true, what's 66,000 minus 26,000, Allie?
40,000.
40,000. So that tells me I have to fund my estimated tax deposit, or my amount on deposit through some other mechanism. Don't have any more withholding, so it's going to be through estimated tax payments. So I'm going to take those estimated tax payments, divide it by the number of quarters, because you have April 15th, June 15th, September 15th, and January 15th. Is that right, Trent?
I spaced out for sure. What'd you
Just
say?
say yes.
Yeah.
Perfect. Okay? So that 40,000 divided over those 4 quarters requires that I have $10,000 per quarter on deposit. So then it says, could the taxpayer wait till the 4th quarter and put it on deposit? The answer to that is no. Because the IRS says in order to be compliant, you have to have the right amount of deposit. Let me be more precise. When you choose to rely on the prior year tax as your benchmark in calculating what it should be on deposit with the IRS says fair enough, but you have to put on deposit an equal pro rata amount with the IRS to be whole. You can't defer it throughout the year. So the 26,000 that's coming in through withholding, they say you have to be made whole through $10,000 for each quarter. Otherwise, we're going to charge you on interest and penalties because you treated us like a bank.
Is there an exception to that?
Exception to what?
To pro rata payments?
It's called current year. If you're using, that's why I stopped myself and said, let me be more precise. Because on the current year, if you use the current year, well, how do you know what to be put on deposit? You don't know what your earnings are for a particular quarter. Which brings me to a point I said earlier, one's easier than the other. Using last year's amount as a benchmark is science. It's just math. What was last year's tax? 60,000. What's 110% of 60,000 or 110% of 60,000? 66,000. What do I have on deposit projected through withholding? 26,000. $40,000 estimated tax payment for the rest of the year. And every quarter, you don't have to think about it. You just send in your $10,000 deposit because it's science. And if you win, and this is going to be in here somewhere, you win a huge lottery or something along those lines, nobody cares because you put in $66,000 on deposit and you met the required standard of what they want on deposit to remain on safe basis. But if you use current year, then it's like, I don't know. Because if you have your W-2 earnings in quarters 1 through 4 at $25,000 a quarter for $100,000, well, that's a known. But if you happen to win the lottery in the fourth quarter and you're using the current year as your number, well, you have this big spike of income in the fourth quarter. And the IRS would say, well, since you had this big spike of income in the fourth quarter, and we're going to demonstrate this, we want a deposit on that because you're using the current year as a proxy for how you want to pay your estimated tax payments. So the variability comes with the current year methodology. The variability is not there with respect to using prior year. Prior year is science, where current year is art. Yeah.
Do you ever, or first of all, does the IRS allow, and maybe people would want to do this anyway, but like if you knew you had your 40,000, like, does the IRS care if I said, well, I don't, like, I'll just write a $40,000 check now and then I don't have to worry about it the rest of the year? Like, is that allowed?
If you give it to them early?
Yeah.
Yeah, they
If
love
you
it.
like, if you like did it in quarter one and then you can just forget about it the rest of the year?
And you know, older clients do that, where they say, you know what, I don't want to put up with the process. I don't want to remember every quarter. Can you just tell me what check I need to cut in quarter one to where I don't have to worry about it? That, I wouldn't say that's super common, but I wouldn't say it's uncommon either. They care if you're late. They don't care if you're early at all. Okay, so since we did this, we paid the 66 in, 26 in withholding, 40,000 in estimated tax payments. We get to April 15th of the following year, and we have to now cut a check for 234,000. Because when we now do our return and it's spot on, we have $1 million of income. $1 million of income times 30% is 300,000. 300,000 is our tax. What we have on deposit, because we used the prior year methodology, was 66,000. 66,000 less than 300 gets me to 234. Now I have to write a check for 234,000 to the IRS. But writing that check to the IRS has no interest and penalties on that because we met the standard of using the prior year amount as a proxy for what would keep us safe. Now, did I talk ahead? CV, what's this say?
Estimated tax based on current year earnings. In general, you have to have or deposit with the IRS on amount equal to 90% of the tax on the income earned by quarter. Facts: if the year one income was 1 million due to lottery winnings and the prior year tax was 300,000, if we utilized 110% of prior year's tax for estimates, it would require 330,000 to be the estimated tax payments for year two. However, the taxpayer expects to get 20,000 per quarter in qualified dividends taxed at 20%.
Okay, so let's stop there for 1 second. So let's all just agree on what the fact pattern is. You have a taxpayer that won $1 million in a lottery in year one. And that lottery in year one says they did the calculation and now they have $300,000 that was due with that return. The same way that we had before in our fact pattern. So now we have two options or two methodologies that we can choose. We can choose 110% of the prior year. So let's go down that path. 300,000 times 110% is 333,000. Right, CV? It is. So then it says, well, gee, you know, I'm only going to be getting $20,000 worth of dividends per quarter because I invested the $1 million, and that's what my financial advisor at LUT said I was going to get off that. So that's what I'm going to use. So now I've gone from the art or science piece of it, 110%, to say I'm going to use the art piece of it because 20,000 times 4 is $80,000. What was it? what was the amount that I'm getting? It's 20,000 per quarter, right? $80,000. $80,000 times 20% is 16,000. Do I want to put on deposit with the IRS $330,000 when only 16 is going to be due? You don't. So you're going to choose to do it on the current year income because you'd never over deposit in that fashion. Okay, so what's A, B, and C say? CV.
A, based on these assumptions, what is the projected quarterly estimates? 4,000 per quarter.
Yep.
B, can you send 4 quarterly estimate vouchers and know they will be safe from interest and penalties? No, you can't.
Okay, so let's stop there for just 1 second. Because what we said on the science one, we knew that $26,000 was going to be on deposit, right? And we knew that we had a $40,000 shortfall. We divided that $40,000 shortfall by 4, which resulted in 4 vouchers of $10,000 each. So we can send those vouchers of $10,000 each and say, you're good. You know, if your withholding's off, you need to tell us. But other than that, you're good. So the point that's being made here is, well, LFS said it's going to be $20,000 a quarter. That results in $4,000 a quarter. So let's just send them vouchers for $4,000 a quarter. And I'm saying you can't. Why do you think you can't? Do I answer that? Well, read C. I do kind of answer it.
C, do you have to examine each quarter's earned income to make a determination of the quarterly tax due? Yes. D, if you assume 20% rate for qualified dividends, capital gains, and 30% tax for ordinary income.
Okay? So what I'm saying is that if on the left is what you're projecting, I think, versus the right of what actually happened, do you think sending a $4,000 voucher to the client would have kept them safe? No. So what you have to do is you have to say, well, quarter one, I should have on deposit $4,000, and I'm going to keep it at 100% versus 90% because I don't want to do the math. And quite frankly, I generally keep it at 100% because you know how often there's some error in the data provided by the client? Something more than 0. So giving yourself that 10% cushion and using 100%, not a terrible idea. So if quarter one, quarter two, it seems like everything was working fine, but Q3, it really went off the rails. So the required deposit, if you just send them the vouchers, and I think that this is what it's saying, maybe it is, maybe it isn't, because I wrote it a long time ago, and it's hard to remember what I was thinking, was that Q3 is projected was 4,000 on the left side, but in reality, we should have sent them 100,000. And in Q4, we would have sent them a voucher for 4,000, but in reality, it should have been 30,000. So the science piece of this is if you choose to use current year income, that means you chose to use current year income. And every quarter, you need to follow up with your client and say, well, how much did you earn this quarter? And then you have to do a calculation on that quarter with respect to how they earn their money. Okay, that's why it's more art than science. Because the other is, do the calculation, send the vouchers, you don't even have to think about it anymore. This one, you have to think about them every quarter. CV, who you want to call on?
Sam.
Who? Number 8. Oh, Sam. Yep, go ahead.
Does the IRS have a penalty on not paying? Yes, it is basically an interest charge.
So the IRS doesn't really want to be treated as if, or a bank, So if you're shorting them their cash based on what the agreed upon methodology is, they want you to pay a penalty, and basically that's interest. So what's 9 say?
If estimates were required but not paid, how does it work? Let's assume that required quarterly was 10,000 and assume the interest rate is 6%. So you want me to just read through that?
Embedded in this is an assumption that they paid 0, which I don't think I intended to do, but sure. Go ahead.
Okay, so like quarter one, we had what, 10,000? Was that 10,000 due? Yeah, the required quarterly payment of 10,000.
Yep.
And 6% interest.
Yep,
So we got $600.
yep,
And then quarter two is again 10,000 and 6%, and then it's times 75%. Is that because it's 3/4 of the year?
yep. You shorted them for 3/4 of the year at that point.
Okay. So we have a 75. Take 75% of that for 450. Third quarter is our 600 again, and then 50% of the year for 300. And then the fourth quarter, we take 25% of that 600 for 150. And so in total, it's 1,500 in penalties for the year. Note, this calculation is done on Form 2210 for individuals and trusts. The above calculation is for illustrative purposes to convey the concept that the
First quarter.
the first quarter shortfall has a larger penalty than the fourth quarter. Please see Form 2210.
You know, when I deal with clients and I'm uncertain as to what their facts are, or I'm uncertain as to what's going on, the best thing you can do is disclaim. That's a disclaimer. That means I didn't really do the work. I didn't want to do the work. This is just introducing the concept that each quarter is going to have a reduced amount of penalty associated with it because of the reduced time the IRS is shorted by quarter. Sam, who you want to call on?
Connor M.
Number 10. If $40,000 was required to be made as estimates and a taxpayer were able to have additional federal withholdings on the December 31st paycheck, last paycheck, would there still be a penalty? No. Estimates are recorded as paid for penalty purposes. Withholding is deemed to be paid into the IRS ratably over the year regardless of timing.
So this is kind of a useful tool. So what this is saying is, if you as an individual taxpayer get a 1040 ES,
That sounds right.
1040 ES, which is your 1040 estimated tax payment form, and you send them a check on December 31st for $40,000, and they magically get it on December 31st, how much does the IRS have in deposit? Max?
What was it, 10,000?
40?
40,000? Got it.
How much?
40.
Okay? If Lutz, Max, says, we'll withhold $40,000 and it magically gets to the IRS on the last day of your December 31st, how much does the IRS have on deposit?
40.
What day did they receive it in both scenarios?
12/31.
12/31. Okay, so the IRS has the same amount of money on the same day, does it not? Okay, so what this is saying is, if that comes in on a 1040 estimated tax voucher, the IRS says, aha, this was received on the last day of the year. You screwed me around. We're going to give you an interest and penalty. But if it comes in on a W-2, withheld on the last day of the year, they go, oh, thank you. We've received those dollars ratably over the full year. So the trick that you can play and planning that you can play is that if a taxpayer is coming up short, you sense they're coming up short on their estimates, and there's enough time to react, you can ask them, do they have enough room in their budget or cash flow that they can change their withholding to backload where we have an error? I've used W-2 withholding to eliminate penalties by saying, we're going to ramp up your withholding, even though the IRS is receiving this later in the year, They aren't going to know. They aren't going to care. They're going to treat this as being ratably received throughout the year, and this will, at minimum, minimize your estimated tax payment on some level. So the point of this is recognizing that withholding an estimated tax penalty for estimated tax payments for penalty purposes are two different things. Oh, the 2210. Oh, how I hate it. Okay, first gift card goes to somebody recognizing when I say I actually like something. Okay, the 2210, let's see, what do I? All right, let's see, let's look at the 2210 just for the hell of it. I don't know much about the 2210 anymore. Page 1 is the required annual amount. Page 2, I gotta remember how this works. What's page 2, Trent?
No idea.
You should be in the guts of this, Sonny. Should be. I can't remember. Okay, so here's your 90%, and probably has your 110% up here, and this tells you what amounts you have on deposit. But page 2 right now, is the penalty computation. Okay, it's kind of coming back to me. Page 2 says, okay, which methodology did you choose, and how much did you have on deposit with the IRS? And then it compares what you have on deposit, and down here, it says underpayment, overpayment. So it measures what should you have on deposit with the IRS. What do you have on deposit with the IRS by quarter? And if the amount that you have on deposit isn't enough, you have an underpayment. And going back to that grid where we had $10,000 due times 6% interest, and that multiplies it by a number, that's what this is doing on page 2. If you have an overpayment, it's going to give you grace back to Sam's, well, wait a minute, if I pay $40,000 ahead, who cares? Well, you're going to have an overpayment the whole way that's going to get depleted down by virtue of this calculation. That's what page 2 is doing. I wish I kind of looked at it before I got here. There's all sorts of things I wish I looked at before I got here. Okay, so, but page 3 is interesting. Okay, so the system, let's go back up a couple pages. Okay, the system is when Chris inputs things in the system, Chris is going to say, well, there's 20,000, there's dividends of 540,000, right, Chris?
Yep.
And there's interest of $100,000. And what the system does, and I think we're going to demonstrate this, much like withholding, it's going to have a presumption that those dollars were earned ratably throughout the year. It's going to presume that's what happened. So when, okay, glad to hear it. That was it. Oh, okay, all right. I'm sure we're going to do this. But this page says, okay, enter your adjusted gross income and enter your annualized income and annualize your itemized deductions. So that page before had $20,000 on it, right? $20,000 in the first quarter.
Yep. Dividends, yeah.
So 20,000, I think, times 4, because that's what was earned in that particular quarter. 20,000 times 4 is going to be $80,000 of income, which said you should have had $4,000 on deposit. So the system is automatically going to presume the numbers you put in are ratably earned. There's input section, and I see the man, because I have no idea where this is. Max, do you ever want to talk to me about computers? No. No. But I can tell you what the concept is. You see the man and say, where do I enter the information to show in quarter one only 20,000 was earned, so it can calculate out. And actually, I think you have to calculate it out yourself and input it, I think. Is that right?
I've actually only done that for C Corps, and we pretty much just did, all right, this is approximately how much they earned first quarter, second quarter, third quarter, fourth quarter. I don't think I've done it on an individual return yet.
It's you have to like input the AGI or estimated AGI at that.
But you have to do it in total, don't you, somehow or something? I can't remember.
From what I remember, it was just
The $20,000 number? Or the $80,000?
yeah, it'd be like 20,000 less your potential
deductions. Yes. Okay. I wish I was better at this. I swear I do. Yeah, I'm going to stick with yes, but
I think that's correct. And then I think it's by quarter, it's a total. I don't know. I think it like cumulative.
yeah. So you have to use those numbers and put it in the specific quarter. Because again, when the input was put in, it presumes all those dollars were earned ratably. So the 540,000, it would think that 120,000 or whatever the number is, 106,000 was put in ratably throughout the year. We're really only earned 20 in the first quarter. And it's going to want to charge you a penalty based on 106,000 in quarter one versus 20. So this is called annualization of income. And somehow I think we're going to be talking about that. Okay. Allie, what do we have here?
Jack is a new client to Let's. He became a new client on 9/1. In the initial call, Jack said that he won the lottery in the previous year, which resulted in a tax liability of $10 million. He invested the money and he consistently earned the following for quarter one and quarter two. Do you want me to go through that?
Yeah, it's interest, qualified dividend, K1.
For quarter one, interest is 200,000, qualified dividend is 300,000, and then K1 is 500,000.
Okay. And what's below that?
Jack has 540,000 on deposit for estimates. In his initial call, Jack said that quarter three was going to be exactly the same as quarter one and quarter two. Let's advise him to make a 270,000 quarter three payment. Jack called and said one of his businesses sold an asset and wants to be sure that the quarter three estimate was not affected. He owns 99.99% of the business, and he sent the following balance sheet: PP&E of $3 million, accumulated depreciation of 500,000 for a total of 2.5 mil, debt of 3 million, equity 0. Question: what should Jack's quarter three estimate be?
Huh, hold on, that's weird. Huh. Must have been drinking again. Either that or I did this as a trap, which is possibly true. Do you have enough information to make that determination? I think I did do that. Now that it's kind of coming back to me. Should we adjust the information or not?
I don't know.
Did you answer Allie and I just miss it?
I said I don't know.
Oh, okay. All right. I just didn't hear you. Jackson, should we adjust the information or not?
My initial thought is that we don't have. I'm not sure we can we calculate his gain on that sale, which is what we would use to adjust it.
100%.
Okay.
Because at the end of the day, my point in this slide, on some level, is clients are going to call and give you incomplete information all the time. And Sam, what do we have to do?
Diagnose.
And what I mean, you have to know something. You have to know where the boundaries are in order to be able to diagnose. And when I looked at this, I'm like, I had to be drinking. Because I'm looking at this thinking, there is not nearly enough information here at all to make an assessment or determination. And then it dawned on me that's exactly what I was doing. Because you'd have to ask Jack, wait a minute. You gave me a balance sheet for $3 million, PP&E of $500,000, or a cum of $500,000, net book value 2.5, debt of $3 million. Okay. Well, Jack, what did you sell this for? And what's the fair value allocation? And you have to be able to ask a series of questions in order to discern. Because if Jack says, look, I sold this for $2.5 million. Do we have to adjust the estimated tax payment? We do?
Well, I guess you need more information.
Do we?
Yeah, basis.
We
Accumulated-
have to- well, true. So now Max is saying, well, this is bad. I made an assumption. Is this a gap financial? Is this tax basis financial? So I failed Sam's diagnosis test because I didn't ask the proper question in terms of, is this tax basis or not? I made an assumption, which is bad, that it's tax basis. So let's pretend it is tax basis. It sells for $2.5 million. Does that affect it?
Mm,
Yeah.
could be debt relief if the debt's connected to the asset.
Well, but if you sell for $2.5 million, so you're saying, let me put back to you what I think you just said. You're saying Jack called and he sold for $2.5 million, and that could be cash.
Yeah.
So did they assume the debt? I think is your question.
Yeah.
Allie, how do you feel about that follow-up question? Debt.
That really?
Debt relief. But did it occur or not?
Yeah, because I guess that's like part of your proceeds definition.
It would be. So what Jack is saying, or Chris, excuse me, is that on top of $2.5 million, I'm doing no gain or loss. Now you guys are playing tricks back on me because I'm not asking enough questions. Is that, well, somebody calls back to my $8 versus 10, or 8,000 versus 10 the other day. Debt relief's part of it. So now you're playing the trick back on me that I was playing on you, which is good. So 2.5 of cash plus debt relief. Sam, are we in the pursuit of diagnosing? We are. Actually, you just aggravated me because I was stupid and you were smart. Oh, shit, we're out of the small gift cards. It's bigger. Yeah. Okay, so it really is. Actually, I'm very pleased with what just happened because I was stupid 3 times and you guys were smart 3 times. Because at the end of the day, Max said, well, wait a minute. It could be a gap financial, right? Could be on tax basis. I sell it's 2.5 and I answer his question. And then you say, well, wait a minute. What about debt relief? That is really taking the things that we're looking at over the past couple of days and wrapping it up in a completely different context. Proceeds, debt relief, and all those things have nothing to do with estimated tax payments until you have to, Sam, diagnose, because now somebody's calling, said we're selling something, and you're taking those individual pieces to assess the tax consequence to this, And the only way you're going to know how to adjust the estimated tax payment that's here is by diagnosing the tax consequence of that sale. Correct? Actually, I'm kind of happy about that. I think I said I'm happy. Doesn't count. I caught it. It might count. I got to